Hey everybody, it's Erik, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Venture Stories with Village Global. I'm here today with my friend and very special guest, Arjun Sethi. Arjun, welcome to the show.
Good to see you, Erik, and thanks for having me.
Arjun, you are a serial entrepreneur and investor, formerly founded MessageMe, Lol Apps, was a partner at Social Capital, and now you are starting your own firm, Tribe Capital. Why don't we talk a little bit about what you're building at Tribe, what you set out to build, and what's the thesis behind what you're building?
If you think about, a lot of people have asked, hey, as an entrepreneur, why are you building a firm? Why are you deploying capital? And it goes back to what my founders and I at Tribe have done for the past 10 years. So we've built products from scratch in consumer, in SaaS, invested in those categories. But when we did it, it was at a time that I think was fairly special. If you think about it, post 2001, you get into the era of 2005, is where companies were leveraging their data to make better decisions. So one of the companies that people always remember is Zynga, obviously Facebook, which is they had these data science team and people that were kind of assigned in parallel with product managers and engineers to make decisions and bespoke hypotheses around what was happening in their products. I mean, in some cases, it's fairly behavioral oriented. In some cases, it was paid acquisition, customer acquisition, LTV, et cetera. And so in order to have done that, you would build the right infrastructure. You would build the right set of teams. You'd have the right set of software and infrastructure that may be third party or you built internally. And then you would make ideally better decisions with it. Yeah. And so we took a first principles approach to how would you do that in venture capital? And if you think about it, what you're doing is you're delivering capital at the early stage where you have a more active role in having the companies being built. And so how do you build context? Well, you could build context by having industry knowledge or sector specificity as an individual, or you can say, well, what are all the common denominators you need in order to build a company, and how can you help companies step function? So what we did is that we felt we were the masters of product engineering and data science. And we would take the culmination of all of those three foundations and assess companies in that way. And we started that at our predecessor fund, where, a lot of credit goes to some of these frameworks that were built from my partner, Jonathan, at Facebook. And then he brought that when he came on to Social Capital, where we had unlocked data for our company after we invested. Over time, we used our own softwares and tools to essentially ingest the data, store it, continue to analyze it, retrieve it as needed, and get better and better at understanding our own companies and then providing that back to them. And then the next question you ask is, well, can you do that earlier and earlier in the life cycle of the company? And then can you do it earlier and earlier in the life cycle of when you meet them? And that's essentially what we set out to do. We started productizing learnings that we had on the data science side, and then we delivered it back to a company. We call it the Magic 8 Ball. It's something that's been continued to evolve over the last 6 years, but we started it so long ago, and then we continue to use it across multiple companies, multiple stages, for better or for worse. Yeah. And then our frameworks just got better and better and better, because the N number of companies that come onto our platform or they meet with us, we are able to derive better results for them and interpretations of how their company is performing. And so that really started out with Jonathan writing set of articles that were about growth accounting and a quantitative way to measure product market fit. And I think what you've seen a lot in the Valley is everyone believes they have product market fit on the founder side. And everyone who's an investor qualitatively believes they know how to assess product market fit. And so what we wanted to do is take a first principles, building a product from scratch, approach to how do we deliver what it means to have product market fit. So the line we use when we meet companies we are investing in N of 1 outcomes. And in order to do that, we take a quantitative based approach to product market fit, and we deliver that by our Magic 8 Ball over and over again. That helps you unlock the data that you have. So we can identify product market fit and we can help you amplify it.
Right. And unpack more your N of one thesis as it relates to one event company. Like unpack what that means.
Yeah, it's what it really means is that you have monopolistic tendencies in certain sectors. An N of one company is essentially a company that's category defining, or it could be the market itself.
Yeah.
And you're able to slowly, in some ways, improve the category which you're in, because you can either take fragmented services and make into automated software, or you have a network effect for the company that you have, and you're able to go into adjacent territories at high velocity. So N1 companies really, to us was a term that, stemmed from our days in social gaming. Yeah. Social gaming wasn't one of N companies that were fighting for it. And we all believed we could try to get to N of one outcomes by having a network effect or a conglomerate of customers in our products where we could move them from adjacent product to adjacent product. Didn't work out. Didn't work out for Zynga. Didn't work out for us. Right. But we got far enough where we were one of N companies. And so our goal was to help identify companies get to N of one outcomes versus a one of N company. Now, does that mean we don't invest in one of N companies? No. It just means knowing where you are in the ecosystem, knowing how to think about building your teams, your sales force, your product, just having a guide map of how to perform.
So it's interesting. Yeah, there are markets that are winner take all, and then there are markets that are so big, that is not a N of one company, but the market is so big. Mm-hmm. What's different when you're building a company in an N of one market versus a one of N market in terms of?
Yeah, I mean, no, I would actually say, Uber and Lyft are N of one outcomes, because there's just two of them in the United States. But if I was to take a global perspective, then you could say there's lots of competitors all over the world, and it's hard to compete, outside your geography. An N of one outcome company is Slack. An N of one outcome company is Facebook. An N of one outcome company for us is companies like Carta, where you see very clear signs of network effect, very clear signs of adjacent territories that you can go to. And what I mean by very clear signs of network effect is that you can quantitatively measure that this company is eating everyone else in its way. So that's for us is, special circumstances of when we feel like there's an N of one company.
Let's cover a couple of those stories. So tell us the Slack story and what we can learn as investors or entrepreneurs about that company's rise.
I mean, there's so many narratives about Slack. When we first invested in Slack, it was through our partner, Ted, and at Social Capital, and he had known the team through a company called Cozy that they were both on the board of together. And obviously, Slack had gone through a pivot. They were previously a game company, and they had used some of these tools and communication paradigms to communicate with not just each other, but a way in which they thought would be the right way to build communication. And so the early companies that they used this on and they tested with, one of them was Cozy. And the way in which Ted got board updates was through Slack, right? And he got information. So his context in the company was rising. So for him, it was really valuable. What I think what's really important here is at that time, a lot of investors look at companies, they think of it as tired or they've raised too much money. They were a game company before. They can't be an enterprise company. It's like, it doesn't fit their mold of, or their biases of how a company should be built in a sector. And we took the bottoms up approach. The bottoms up approach was, well, let's see how they perform. Let's see the demand signals that make sense for this company, given that there was barely any revenue, and engagement was there and, a couple of customers. And the team at Social Capital really dug in deep and assessed the data. What's more important is that we continued to assess the data of the company across multiple stages of investments, not just during the Series A. And so, a lot of people say, hey, you can't really assess companies at the Series A. Well, if you think about it today at a Series A, when someone's trying to raise between $5 and $10 million, they have raised some seed capital. Let's just say between 500K and 3 million, if you think about that wide range. And they've probably had their product out at the minimum 3 months and up to 15 to 18 months in some cases where they are testing and iterating. Well, that's a plethora of data to look through to see how it's been performing. And it's always shades of gray. It's never perfect. There's no company where you look at their data, their primary data. And I think this is the important part. This is not something that they provide to us in a deck. We're ingesting it and then we are assessing and analyzing it and then giving it back to them. There are multiple ways in which you can kind of approach the market, or, B2B SaaS, top down, mid market, small to medium, consumer subscription, even consumer enterprise, B2B to B2C in some cases when you think about energy. So there are multiple frameworks that you can use, and there are multiple ways in which you can, essentially assess how is this company doing? Where was it before? Where is it today? Right. And what will it take for them to scale from a venture scale outcome? I think what happens is a lot of people just see a number and they get excited. And in some cases, they've already made the decision and then they try to back it up with data versus the other way around. Right. And so our whole goal is to flip the coin on its head. When we meet entrepreneurs, we tell them, don't pitch us, we'll pitch you, give us access to your data, and we will run our analysis on you. We'll give you the magic 8 ball back, and we will show what kind of value that we can add. So we look more like a data and analytics system, but with consultants on top of it. Right. So it's kind of like the McKinsey way of understanding what it means to be in venture.
Yeah. Let's talk about a few of those frameworks. So when you get the data for, let's say, a consumer social company, what data is most important for you in terms of what will determine whether you're likely to invest?
Yeah. So a lot of this is also just secret sauce, and some of this we've put out. Jonathan has published this around just demand signals that we care about. But there's no right or wrong answer, and I think this is part of the key. Right? Some people will say, "Oh, you need to have really great retention." Well, you can have really great retention, but you can have no net expansion of growth. That's not a company you want to invest in. You can have high growth, no retention. That's not a company you want to invest in. So there's a lot of pieces that you care about. I think it's more, a lot of these frameworks exist on how to assess it. That's not a secret. It's just more about the interpretation of how do you get the data. So one, you have to ingest it. That's non-trivial. You have to have a framework to assess it. That's non-trivial. You have to be able to productize this and put this into a package that's readable. That's non-trivial. Yeah. And then you've had to have done it so many times, thousands of times, which is what we've done. And that's also non-trivial. Yeah. And so I could go into any company and say, here are the types of things that we look at. But, for any consumer company, it's basically you're looking at all forms of customer engagement. Right? And some forms of that customer engagement is just the intent and the way in which they came. So it could be anything, right? Like I think demand signals is what you care about, and then you go to the next level, right? The next thing people will care about is unit economics. For some people that matters a lot, some people it doesn't. So it's more about how do you interpret the data once you have it and the accuracy of it. We feel like we're very accurate at it because we have a ground truth perspective on how the company's been performing.
Yeah. How about on enterprise companies? How does that differ for you in terms of what you look at or where you can be most helpful?
It's essentially the same, right? And any company that builds software is measurable. And you just have to understand what are the demand signals that you care about with your investment framework and philosophy to invest in that company. Some people are okay with a slow growth, 6% year over year. Yeah. Some people are not. Some people want 50% year over year. Some people are not okay with that. We generally on the venture side are looking at 3 to 5x year over year growth in something. It could be users, could be revenue, could be customer engagement. There's something that is helping propel the company forward. And you're digging in and becoming more bespoke on what you care about.
Talk about Carta, because I think that company took a lot of people by surprise. You saw it, and got all of it relatively early. What did you see in Carta that maybe others did? What give them from the story?
Yeah. I'll take a step back, and to talk about Carta, we talk about Slack, and then we talk about Facebook. And what's really important, and again, this is just another indication of how traditional VCs have their mindsets are. A company has raised a certain amount of capital. They didn't really hit the certain metrics when they saw it, and so they just assumed the company is tired. This has happened time and time again. When we assessed Slack, we were able to eventually assess what we believe was an N of 1 outcome, that there was a possibility to replace email. And you could see multiple networks internally and externally. And I think this is the key thing, that we're interacting with the product, with each other. So very similar to email, right? Like I'm not within your organization, but I'm willing to talk to you and I can create communication protocols to make that happen. So we saw that. That's measurable. That's, uniquely identifiable, in a quantitative way. Facebook is well known for this. And our team, has done this so many times that we were able to kind of recognize this. And I wouldn't call this pattern matching, because pattern matching would be, I think this can happen. Because all these companies, when you meet them during their series A and B, they'll say, I believe I have network effect. I think I have this. Or they'll say it with confidence, but they can't measure it. Yeah. And so we always go in and say, okay, well, what can we quantify around those types of statements? What can we quantify ourselves if we have a thesis? And Facebook was really the first company outside of the social gaming companies around that same ecosystem, where you were measuring network effect of growth in, parts of the United States, at a high school, at a college, Japan versus Turkey, different flows, user account privacy control versus newsfeed. All of these things had different frameworks around understanding growth, right? And if you really think about what growth means, it just means product market fit and can you scale it? And so we did this at Slack, as I mentioned. And when we met Carta, we used these frameworks to understand, hey, does this company have any semblance of network effect? The company says they have network effect. We're hearing it ancillary wise that there's network effect, but we don't know for sure. So can we measure that? And so we did. And so we saw a lot of early signs of connections between stakeholders, right? Stakeholders are employees. Stakeholders are the company themselves. And stakeholders are the investors that invest in the companies. And then we saw multiple interactions that started getting stronger and stronger between those nodes. Again, that's measurable, something that the company had not done initially. And so part of our goal was when we invest, let's help them align and reorient themselves to think this way. Similar to what we did at Slack and similar to what the growth team and the data science team did at Facebook during the early days. So that's what we set out to do. So we did the Series C into Carta, and then we did the Series D, and then we basically aligned ourselves with the company for as much as we can around orientation of what they can become on products that can be built on top of their network. Yeah. And one of the products that obviously people know about is the 409A and then the cap table. And really recently they went into investor services with fund administration. But if you basically look, they have 10,000 companies on the platform. They're going to have a couple hundred funds on the platform. The AUM that comes from those funds, you basically see this, system of record monster company, that can be built, and they can go into as many adjacent territories as they want because they're building a network that just continues to reinforce and strengthen itself. Yeah. Similar to how you've seen other network effect companies.
How did AngelList miss this opportunity?
I don't think it's about missed opportunity. AngelList is a great company too. It has, built an ecosystem around angels themselves, companies hiring, making sure that you can kind of propel them from one stage to the next. And I think what you've seen them do is evolve from the early stage to parts of the mid stage by keeping, pro rata and value add services. So I think they are completely different companies with different types of network effects. Yeah. One is more prone to high frequency of transactions and the other one is more prone towards qualitative transactions.
Yeah. Let's talk about product market fit because it's something you guys are very rigorous about. What are the most common mistakes or misconceptions people have around product market fit in terms of maybe thinking they have it when they don't or not realizing when they do have it or someone else does it?
If you're a team that has raised a couple $1 million and all of your investors at the seed stage are saying, it's time to go raise, I see some metrics and it's really great. You're a team that speaks very confidently about what you're building. Of course you feel like you have it. You have this irrational passion to build something that you wanted to solve. And your problem set with your solution set, you believe is starting to work. So in some cases you believe it yourself, without any quantitative data. And then you use some surface level data in some cases to propel you forward and say, I think I'm ready for venture capital to scale 5 or 10x from here or 100x from here. I think part of the issue here is if you don't know quantitatively if your product is working or not, that's one part. And then the second piece is how much capital should you really raise to get to the next milestone? Should you really raise a Series A or should you raise half that amount to get to the next milestone? So a lot of what we try to do is just ground truth, have a conversation. Just here is exactly where your company is. Here's how you've performed. Here's what it's going to take to get to the next scale. This may or may not work. And in some cases, these companies are not meant to have venture capital. They're meant to distribute capital back to themselves. They're meant to get a loan. They're meant to be a small to medium business. If you were to have us assess product market fit for, a local coffee shop, they might hit all the marks. They have retention of customers. People keep coming back, but they're not growing. They don't have any net expansion, but they are good enough for where they are. Does that company deserve venture capital? Maybe if they have a unique value proposition in the way in which they think about growing. But in most cases, they won't. They won't need venture capital. So I think a part of this is that we see so many companies all over the world. Roughly we'll do our assessment on about, 200 to 300 of these companies where we go really deep. And it's really great because this is the first time they have a view of how investors view them. This is the first time they get to see data science and product engineering in action to gauge and grade what they've done so far. And it's the first time they might, learn something new that they've never learned before about how they want to strategically move their company forward. So then you ask the question to the founders, okay, great. Now we're in alignment about ground truth, which is the hardest thing to do. That is the hardest thing everyone tries to figure out. Now that you're in alignment with ground truth of how the company's been performing, let's start a discussion on what it takes to go to the next stage. That's a much easier way of building alignment with founders and investing through them than believing in a story, telling your other partners, I think they can do this, especially when you don't know the question of, is it working? And that's the main problem I think we've always seen with the industry, and what we always wanted to try to solve is, how close can we get to quantitatively answering, is it working? In some cases, you can't. That's okay. There are companies where there won't be enough data to make a decision yet. And again, the data doesn't tell you to make a decision. It's just a part of the equation. Right? If you look at the three foundations of any company, product, market, and team, there's very little data on the team. Everyone basically has their qualitative frameworks around how to assess a team. We look at, product centric, metrics that we get from the software that they've built. And then there's the market. And you kind of take all those three pieces and ask, do I think this is a venture scalable model?
Right. To expand on some of the product market fit points you were talking about, what are sort of the different quantitative approaches, that you take to evaluate?
I think I would just, echo what I said before. The approach is really very simple. If you're a engineering team, product data science team at the company, what are the things that you do to try to understand what is working in your company and what is not working? That's essentially what we do. We come in with our heuristics of how we've viewed any company. We look at customer engagement, retention, whatever you want to define it as, always different for each company. And we look at the primary data that the company is throwing off, right? This is a treasure trove of information that matters. We take that, and then we basically build our own bottoms up view, and then we try to, and then we present that back as if it's like a dashboard for the company to see. And then we start the discussion on what makes sense, what doesn't make sense for their company. When we're building this bottoms up view, you are learning about so much of the company, what's valuable, what's not, so that you can start asking the next question. What's the qualitative stuff that matters, right? How did you do this? What happened to pricing? Why was there this blip? What was the way in which this affected these cohorts? Not to test them, but to ask what their plans are on their future roadmap. Right. That's really important, because if you're a product manager at a company, what do? You look at past performance. You look at bespoke analysis that you're going to do in the future. You look at the way in which you're going to test stuff. And then you have your engineering team and your data science team come up with plans around what the future roadmap will look like. We're almost no different. We're coming there to try to figure out how to align with the company as much as possible and gain the most context.
Right. So when one thinks about venture, data-driven venture as a product, I guess you sort of separate it into a few different ways. One is how you source companies. Two is how you diligence companies. Maybe three is how you support companies. Mm-hmm. Would you agree those are the buckets?
Yeah, the way we define stuff is there is sourcing, there's evaluating, there's aligning, and then there's managing. Places where we focus all of our attention, almost 90%, is on the latter three. So on evaluation, as I mentioned, we ingest the primary data. On aligning, making sure that the way in which we think about helping the company step function is in alignment with the company and they believe in the strategy. Otherwise, we won't partner. So we are fairly concentrated. We are not a fit for all companies. And managing the company towards success, where we continue to do more bespoke analysis as they get larger, or if it's not working as well, where we can unlock more data for them to help them make better decisions. We are not going to make the decisions. Our goal is to unlock the data so that they can make the decisions. And it may be right or wrong, but if it is the wrong decision, at least they'll know sooner rather than later.
Yeah. And when you say unlock the data, why are they incapable, or what do you know about unlocking data that the company themselves may not know?
Yeah, in some cases, there are companies that are very good at this. It's very rare. I think what you see is we have a holistic perspective on companies, markets, sectors. We see multiple companies, the way in which they're performing. So we can continue to benchmark, gauge, and kind of show the value of what a company needs to aspire towards in order to be best in their class. Right. And it's actually pretty rewarding, because if you set everything to ground level and truth around how you are performing across all of the appendages of your company, you tend to start making different decisions versus, through your gut, or I believe this. And it's not to say that you don't have a vision or a North Star. It's more about, what can I get access to make better decisions? And that's the whole point. The whole point is, can we help accelerate a lot of these companies because they haven't built these teams out before? When you hire a data scientist, you can't just tell them, do this. They have to have an understanding of your business, the heuristics, what to kind of start digging into. And the best companies in the world, like Google, Facebook, et cetera, they've been doing this for so long that they've mastered certain parts of what it means to have data scientists and engineers focus on this path of product market fit. Whereas, if you're a company of 2 people, if you're a company of 10 people, you've been focused on surviving and getting your product to a working state. Right. And so our whole goal is to let us help you define that working state and what it means to make that working state stronger and stronger over time. I think some companies are capable. Our whole goal is to teach them this over time so they can do it themselves. But as we've seen with a lot of our companies, regardless of stage, there's always something new that they haven't done, and we can continue to help them unlock it.
You don't focus as much on the sourcing side. Is that because there's less of a unique advantage to be gained from data science?
Sourcing is an aspect of, I think it's one part of the equation that matters for obviously venture capital. And we've always partnered with other firms. We've always gotten inbound and, strong referrals as well. So we're not opposed to using data science to source, but look at kind of the parameters of what you do. A lot of the parameters of data sourcing, using data to source is, let me find publicly available data. You're either scraping or using credit card panels. You're looking at Crunchbase, PitchBook at different stages. You're looking at the YC list, and you're just going out to those companies, and you're hoping you might like the idea. So you're taking a qualitative framework of, do I like this market? Do I like this team? So again, across those 3 verticals of product, market, and team, you're using your frameworks for what you think matters, and you might pass. Our whole goal is, let's build a bottoms up view. Let's do the work on the company. Let's pitch to them on why we think they might be worthwhile, regardless of where it comes from sourcing. It's not to say that we don't use data science for sourcing. It's just not something that we focus on, as 100%. And let's make sure we're not going to miss the best companies because we had a bias. And that's our main goal. And that gives us the ability to invest in founders, where, someone might have been a waitress and she wants to start a B2B company, where someone was a karate teacher and decided to start a vertically integrated SaaS company. Someone had built consumer products before, failed, but decided to build an enterprise company. And the 3 companies I'm mentioning are all companies that are worth over, $500 million and more. And so I think to understand, how powerful this is that we get to reduce bias. We get to partner with anyone from anywhere in the world, and we can help them accelerate their business because we have a view on the way in which companies get built. Once you get to close enough demand signals for product market fit.
Capital as a Service was trying to be a unique sourcing tool, right?
So Capital as a Service at Social Capital was essentially built on the frameworks of what we had. So we had different heuristics and frameworks in understanding product market fit for certain companies. And the goal was for, one of our teams at Social Capital to find possibly outlier style companies outside of the traditional areas of venture capital, like, Silicon Valley, New York, LA, et cetera. And, what I'd say is that, you could have a framework of using software to make investments, or you can have a framework to think about using software and data to make better decisions. So there are usually 2 extremes. There are people in the industry, in my opinion, that are on one side that say data doesn't matter. All I care about is how I view the company because I've been around for so long. I would call that the traditional VC set, that no matter what stage you're at, they use the same framework, from Series C to Series D. And I see that over and over again. And then there's the other side of the world, which is, I think, what you saw at Social Capital, which is we can automate everything. Where we really kind of fit is in the middle, right? When you are building a company, there are people, there are variables that are human. You have to work hard to help the company get from stage to stage, even as a VC. That does matter. And, our whole goal is, can we get as much context in the company using our data science so that when we need to do the other aspects of company building, we're there to force multiply in the way in which we could have done it as a past as one individual, right? We are our firm is set up like a company. I work on product. Ted works on operations. Jonathan works on tech. So it's you have your CTO, COO, and CPO, And we have data scientists and engineers with the team that are like fully focused on helping our companies as a partner. So we don't have Monday partner meetings. We almost never make decisions only on a Monday. We have stand-ups every day like a product team, and we're building products and we're building relationships with our companies. And so I think that's part of the equation of why we are focused in this way versus being on either extreme.
Yeah. Let's go into those three elements, team, market, and product. Maybe team, because sometimes I'll see you're investing or consider a team that is maybe young or early or doesn't have a ton of data on them and maybe is early in their sort of traction as well. What sort of qualitative or quantitative frameworks do you have for evaluating a team?
Yeah, we're all very different at the firm. We have this perspective, given our sweet spot is $5 to $10 million checks, Series A and Bs. We do other rounds at other stages opportunistically, but again, it's the word opportunistic where we feel like we can help the company step function. And at the earliest stage, I want to call it pre-seed and seed. It's different frameworks, right? You have teams that have never built anything before. That are coming in fresh and saying they want to build this product for this market. Here's our solution. And it might be that whole team and napkin idea. Then you have some that have a demo, which is like, this is what it's going to look like. And then you have people that are coming out of companies that we all know well, that's saying, I want to build a company in X sector. Here's my background. I think I can do it. Give me capital. And so you use different frameworks across all of that, right? You either like the market and the team. That's a framework. You like parts of their product. And the market, you may not like the team, but you may still do the deal. I think you've seen that from a lot of people. I mean, we tend to, consider ourselves, tribe-like in that we want to treat all of our companies equal, no matter what the check size is. And in order to do that, we end up having to be more concentrated, but also more, opportunistic with our time. And so when we do write a small check, which we call it our angel style checks, is that a partner sponsors an area that they care about. So if I'm doing a deal, I will act like an angel, which is I'm going to be accountable for this check and I'm going to be accountable for my time to that company and make sure that they're actually integrated with all of our companies in portfolio, regardless of the check size that we've written to the other portfolio. Yep. So if someone has a $25K check that we've written to them, I'm treating them the same as a $40 million check that we've written.
How do you think about markets? Do you have sort of a tops down, hey, we're excited about these markets. Let's go find companies who are doing this in this space, and vice versa. If an ad tech or martech deal comes in or any space that's non-grata these days, are you crossing it off, or how do you view markets?
Everyone says they like big markets, but we don't know what big markets are. I would generally prescribe to Mark Andreessen's philosophy that software is eating the world. And then I would take that a step further and say software is being proliferated in everything we do. And so if you just take that into how we live our lives, how much time that we have throughout our day, and what are we doing in those chunks of time? Like, what are the products that take up that space? We generally kind of look at those markets, right? You'll look at energy because you use energy. You'll look at real estate because you live in a home or a house. You'll look at obviously transportation, auto. You look at all these pieces, and then you look at the full vertically integrated stack of what is in this industry and what's either being deregulated or fragmented because of software. I could go on about every single one of these markets, but we're generalists by that fashion. We look at markets that are interesting for us, regardless if people think it's small or not. We don't actually care because we believe that if we build a bottoms up view, we can have a better understanding of what the TAM could look like for a company. Yeah. And given that we're investing at the early stage, TAM may not matter if you give it enough time to matter.
Right. Yeah. Let's talk about a couple of companies in your portfolio that I know you've led the A or B of, and C, or A and B, in the case of Cover, and just talk about what you saw in them that maybe others didn't, and how you thought about, your unique ability to support them. That sort of demonstrate how you would try to think about supporting. How about Cover? What sort of did you see that led you to lead the A?
Yeah. So, first off, thank you, because you made the introduction. So I appreciate it. But, we met Cover and they had this thesis, which is important, that most insurance companies today are built, one product line at a time. So if you kind of go back to the advent 10 years ago of the companies that are being built, they're doing renters insurance, auto insurance, homeowners, life, etc. And they're all very specific to a product line. And Karn, who's the founder, and Natalie, who's one of the co-founders, and Anand, the three of them together, they basically had come to us and said, the way in which insurance company of the future is going to work, become big and massive, is to do two things. One is to be an insurance company actually similar to insurance companies of the past, so back to basics, and being able to not turn down any customer for any reason. So how do you do that? So it sounded crazy, and I just kept asking and asking what this would look like and what their approach was. And so their whole approach was, we want to be a broker. We want to be a Switzerland in the space, but we also want to have our own product lines. What does that allow you to do? Well, that allows you to not turn down a customer. Okay, great. Well, how do you actually do that from a product perspective? And so in most cases, people look, oh, Cover is the mobile app. Well, they're not just the mobile app. They are a choice on your point of sale system. When you do a driving school in a certain state, they are also your option. They just have a multitude of ways in which they engage with the customer, which I think is the most unique part about them, is that they don't consider themselves a next generation mobile app insurance company. They think of themselves as a next generation insurance company. Yeah. And then they have channels in the way in which they approach the customer. And those channels are products in themselves that kind of aspire to the intent of the customer. You may want to do it just all through mobile. I may care about getting a hold of someone, an agent on the phone. Someone else only wants to buy insurance through their channel partners. Another person wants to consider a broker that they are already working with, which Cover will also work with. And they don't want to change their insurance company. So they'll just use Cover to represent them as a broker. And so if you look at that flexibility of what they can do, they can end up working with anyone, very similar to the way in which insurance companies work today. Like, having that type of vision in the beginning was great. Clearly, as venture capitalists, we didn't believe it right from the beginning. So our approach to kind of understanding what was working and what wasn't for Cover early on was to understand their product market fit across all their channels. Right. Their first channel was mobile. Second channel was Shopify. And then the subsequent channels after that. And so then when you start thinking about their unique value proposition to the customer, how do I measure success? And then how do I measure product market fit? Not just as a holistic company, but just each channel as product market fit. That's how we gained conviction. Then we took all that, productized it, gave it to them and said, here's how we think about what's working, what's not, how we would prioritize our time. Here's how you should think about your capital. They ended up being one of the most capital efficient companies in the space. They're growing at such a rapid rate. They've, I would say in many cases, they're rivaling a lot of people that have raised hundreds of millions of dollars. But they're doing it at a pace that's sustainable. They're doing it at a pace of what we believe is going to be the next, insurance company that's going to last decades and be resilient.
It's really interesting. I feel like, this has led, thinking about venture as a product and data-driven approach. You guys at Tribe and previously at Social Capital really pioneered, and others haven't really followed. And you've seen even the best, Keith Raboy, and you talk about how it's really an artisan industry and how it's most likely not going to change or be very different. Or, Founders Fund, doesn't really do this stuff, or Benchmark doesn't really do this stuff, or Mark Andreessen and Andreessen Horowitz doesn't really do this stuff. What do they see sort of different about the world that they sort of see venture as more of this artisan?
So I'll flip it back on you and ask, well, if you've been doing something your whole life a certain way and it's kind of worked for you, what's your motivation to change? Not a lot, right? If you've been doing product management the same way for a long time, your motivation to change is not a lot. So a lot of questions, VCs ask, why doesn't Google do this? Why doesn't Uber do this? Why don't these other companies do it? Right? When you're doing a Series A, it's one of the stupidest questions people ask, because if you're used to doing it a certain way, you usually don't adapt or change, right? Yahoo didn't adapt or change to Google. Google didn't adapt or change to Facebook, right? Like, there's just multiple stories like that. So it's the same thing in venture. Just because venture's been done a certain way for 40 years doesn't mean it hasn't changed or incrementally changed. It has. Some funds have gotten larger. They're deploying capital at later stages. Some have become registered investment advisors. Some are using data for sourcing. That wasn't the case before, because before you had people on the phone just calling outbound. So things have changed. I think people just don't care to admit that the periphery of what they do is changing, but their core investment decision making is still the same, and that isn't going to change. And I think what's wrong there is that, because you use Excel and you feel good about it, doesn't mean that you can't use software scripts and tools to be able to make better decisions and augment you as a human. That's essentially where we come from. We're not saying that data takes over any of our decision making. It just helps us make better decisions. And it helps us make better decisions in the future when we make mistakes.
Yep. 10 years from now, do you expect the venture landscape to look drastically different than it does today? How do you sort of see it playing?
Yeah, there's a part of me that says no, so we can continue to do what we do really well. And then there's a part of me where I hope there are more people that kind of prescribe to the way in which you partner with entrepreneurs, because I think it's really a big value add for founders and management teams. It helps them more than it hurts anyone else.
Yeah.
So I'm hoping that, a lot of this, of what we do, because we've open sourced the way in which we've approached it, gets proliferated further and further. So I would say, 10 years is a pretty long time. Things can change, and I'm sure people are going to try. But, I think it's also hard. Let's just say you were the person, Jonathan, my partner, likes to say this a lot. Let's just say you were the person that came up with accounting frameworks 100 years ago. You have the frameworks, but then it's the interpretation of those frameworks, right? Your statement of balance sheet, your cash flow, et cetera. Everyone has the same level of information when you invest in public companies. It's the interpretation on top of that, what you believe is different, so you can find alpha. It's no different in venture, in my opinion. And I actually think the reason why venture, people use the word power law, or if you are doing a seed or Series A investment, they need a certain percentage ownership. The reason they do that is because they know a certain percentage of their companies are going to fail. The reason a certain percentage of their companies are going to fail is because of the antiquated frameworks we use to make decisions. And so our whole goal has been, our frameworks help us reduce our loss ratio which gives us the ability to have a better portfolio construction, which ends up being more concentrated versus I need, 25 companies and I need one of them to return my fund. Well, you only do that because your frameworks are so antiquated.
Yeah. It's interesting to talk about social capital for a second. I think social capital obviously had this sort of epic rise and then recent, somewhat of a fall. And it seems that it's not anything close to the big fall. So it's like Theranos, which sort of had a legal, legality and ethical concerns. And there's we're talking about Fire Festival that is sort of just epic execution fail and fraud. And then there's things like Clinical, which just raised a lot of money and then I guess don't ship anything. Whereas social capital was doing tremendously well and just maybe had a people implosion. When things like that happen, when things are doing well and then certain things go haywire, why does that happen? Or how do is that sort of does that happen frequently? Have you seen that in your career? Or is that just sort of and one or sort of very an exception to the rule that typically when things implode, it's because they're dying or struggling or there's some black swan thing that happens.
Yeah, if I go back to my career and if I look at my competitive set as well that were in the ecosystem, so let's take Zynga for example. I think you had a very talented team, talented founder, a very talented approach to the market, but the way in which they hired culturally, I think was more mercenary than anything else. And so what happened is that you had a cultural implosion internally of what mattered, what didn't, and then more short-term thinking. So, and I think that's a really quick way of capturing what might have happened at Zynga. And there's lots of other things, but I think at its core was that, rot started to proliferate within the organization. Now, I think you can have that in any organization. And depending on what the organization is doing, how strong that platform is, or what I'd call how resilient it is to rot, is what makes it successful and what doesn't make it successful, right? When you're able to purge those things out of the system or inoculate, so I would say your best 10% of moving the company or your firm forward, you can generally survive. And I think you've seen this in the case of, when we sold our company Lol Apps to Nexon, when we went to Yahoo from MessageMe, you had pieces of this, right? Where, in some cases the platform wasn't strong enough to be resilient to the rot that existed. But at the same time, you have so many smart people across all of these companies. And so the question ends up being, what is the North Star or the atomic unit of what they care about? How do you bring that together? And so, at Social Capital, I would say it's probably some of the smartest people I've ever worked with across any of the things that I've built. And you're putting them together to figure out how to facilitate what, venture capital should look like, what growth should look like, what credit should look like at a certain point, and the public markets. And in some cases, I would say because so many smart people were in the room, we came up with so many different frameworks and ideas of what could and could not happen, that we ended up testing a lot of these theses of what was good and what was bad. I would say the ultimate transition for our team, moving into ventures that we believe we were very good at this stage of investing and why we focused at it. As an early stage venture team. Like if you were to transplant our team, it's essentially the same team that was at Social Capital. And what I'd credit Chamath, to be honest, is the approach that he had taken when he was scaling Facebook, just the rigor and the types of personalities that you wanted in the room, the types of creative ideas around how you could deploy certain types of thinking into a new industry, company, capital, it's far beyond what other people were thinking. And it's part of why we all came together. Was that there was this vision of that we could think very differently in the way in which we partnered with our founders and the companies. And we did that. And so what I'd say, like, the success story out of Social Capital is the framework in the way in which we all think. And then how many other people now that have moved on from Social Capital to the next choices in their life or the next journey is that we're still using those same frameworks. We're still working together on it. We're all still pretty closely tied together, including the people at Social Capital and including Chamath, who we already still work with today. And I think what you saw with Chamath was that he wanted to start building more control positions. He wanted to start thinking about different stages. As you saw with the advent of the SPAC, in the previous years, that he's doing exactly what he wants. And that's really valuable. And we're doing exactly what we want. And there are other, former partners who are doing exactly what they want.
Totally. And in a smaller way, I'm super grateful for Social Capital because I got my start being a scout/agent with Social Capital with you. Just a lot of awesome talent at all levels of the firm. I mean, how did you settle on Series A, Series B? Why not do an accelerator? Take on YC. Why not take on first round? Why not take on the growth fund? How did you settle on that?
If you look at the market today, there's two things that are happening. You have a proliferation of capital that's at the early stage. And then you have a proliferation of capital at the late stage. Now, why does that happen? We have a lot more liquidity in the system. We've had a bull run for a pretty long time. So how do you differentiate at the series pre-seed seed stage? Well, it's brand. It's what you can do to have the company help propel it from the next stage to the next stage. And so there's a lot of what I'd say qualitative pieces of company building, the foundations that need to be built. That's what YC does. That's what you guys do at Village. That's what First Round has done. And they all have a different approach. And what I'd say is, in order for you to be successful in seed, my strong opinion is that you need to have a larger value add of resources to help a company's propel and a brand behind it to help them get to the next stage, hiring, et cetera. And then the next set of investors. And from where we come from, we know how to help companies amplify their product market fit post that stage. We know how to identify it. We can help them think through what's working, what's not at a really early stage. So we end up building a lot of these relationships with, YCU First Round, like we've done many, many times, and help companies kind of guide and say, well, this is what it takes from us to raise a Series A. Do you have to have $1 million ARR with us? Absolutely not. Do you have to have certain amounts of retention metrics? Absolutely not. Right. What we basically are saying is that when we do our general overall check, our health check, when we give you a grading or a score on our Magic 8 Ball, it gives you a perspective of how we think and what would it take to get an investment from us. And that's like a quantitative product or a piece of paper I'm delivering to you to let you know what it takes and what it would take for us to want to invest in you too, right? Like, how can we align? So the reason we chose Series A and B is that's the time where you have shades of gray. That's the time where data isn't everything, where it's just a part of the equation. And we've been able to successfully find companies at the earliest stage using our quantitative metrics and finding companies really, really early, and providing this insight. Because when you provide this insight, our belief is that it helps them step function faster. So that's why we did it at the earliest stage. Now, does that mean we can't be helpful at later stages? No, we are helpful. But, as I mentioned, you've had a proliferation of capital at the late stage. And so it becomes more commodity oriented, right? Like if your company is working at the Series A and B stage, you have a plethora of capital to choose from and it becomes more transactional. Our whole goal is not to be transactional. Our whole goal is to be relationship driven, alignment with the founders, and make sure that we can stick with them as long as possible.
Yeah. Could you see yourself getting into different asset classes over time, like growth or credit or some of the other experiments that Social Capital is trying, or do you say, no, we're just going to double down on this, be best at this.
And our goal is to be the best at this. Does that mean we won't go outside the scope and invest in later stage rounds? No, we've done that. I think it's more, do we believe and are we a fit for the company where we can help them step function, where we can amplify their product market fit that exists today? And if the answer is no, then we're not the right partners. And I think what we've been able to show time and time again is that we're very good at actually still delivering that value to even people that we have not invested in, to quantitatively tell them, hey, we're not the right fit for you. We don't think it'll work for us because this is the type of work that we do. Here's the time that we spend once we invest. But this is a guidebook that we start with, and we don't think we can really help move the needle at all. Yep. And I think that's something that most investors don't do because they think they can do anything.
I want to touch on a few pieces that you've written over the last couple of years. But one is, we talked a little bit earlier, but innovator's dilemma. You wrote a post about how companies can avoid the innovator's dilemma. Let me unpack the crux of what you're trying to do in that piece.
Yeah, we have this thesis that everyone regresses to the mean, which is they become mediocre at a certain point. And you have to figure out ways in which to avoid that. And so to be honest, a lot of the pieces that I wrote were either frustrations that I saw at companies where I couldn't help an outcome, or there were my own companies where I had unsuccessful attempts, or at organizations where I was an executive, a la Yahoo, where I couldn't really affect change because the momentum of the ship was going too far where they were just sinking and I couldn't fix it. And so a lot of it are around these pieces that I've written is essentially identifying problems and trying to find solutions that could help those companies, even while I was there. And in some cases, this worked really well, where I have companies literally print them out and it's on their, when I come in at their office, it's on the wall and it's like a step-by-step guide. I think they've made it much better than I have. And then they kind of build frameworks off of it. And I would say that's more for team oriented stuff than it has been for the philosophical frameworks. But what's really important here is this innovator's dilemma thing really comes from, I had a quantitative approach. As I started thinking about what the quantitative approaches are, how could you just learn more from what's happening and get to better decisions? And the more data that you have to be able to unpack hypotheses that you can ask, get back answers in a much quicker format, my belief is that you will just generally make better decisions. And so a lot of these pieces are about like, how do you just get into that cycle to get to a place where you can make better decisions? It's not just a management team or a CEO, but even like your mid-level folks that are, running product and engineering that are doing this and battling this on the day to day. What are they really fighting for is a part of all these frameworks of the pieces that I've written.
Yeah. And on the note, you wrote a piece about how to build a people platform. Mm-hmm. Earlier, talking about how to build resilient teams. What sort of separates teams who are crumble under duress versus resilient teams, and how do you think about building resilient teams as part of building a people platform?
Yeah, there's I don't know if you've read this book, Thinking Fast and Slow. Yeah. What it really comes down to is some people are reactionary. I just need to fix this as soon as possible without thinking through it. And then some people have an appropriate response. Right? This is like, it's a verbiage that the military uses a lot too. And
you were in the military.
I was. And so one of the things that has always been always kind of astounding for me is that when companies are building, they kind of react to growth, right? Like I don't prescribe to blitzscaling because it creates more mercenary style attitudes. And I actually think it creates more biases in the organization because you keep looking for more of the same versus the diversity of thought. Yeah. And so they just keep reacting. So this, if I just slapped you across the face, you would immediately react to it. And that's not what you want at a company. You want to have companies create responses. And so I've always been kind of puzzled by the way in which some companies are advised by their investors around, you just need to hire this person from this organization because they, grew this company from 50 to 100 million in revenue. And so what they do is they go after these resumes. Well, almost every single time that I've seen this happen is that the resumes don't add value to the company. They actually create more toxicity. And the companies that I've seen work really well is that they grow their ingrown talent to create a ecosystem for them to succeed and inject the right people at the right stage, regardless of resume or not. Companies that I think I've seen do this successfully, not perfect. Having companies like Facebook. Obviously there have been some social gaming companies that have done this in the past too. Ones that worked really well and ones that didn't. And you can kind of see the teams that worked really well are the ones that just generally had less churn. So it's not a complicated thing to understand is that if your employees are generally happy with their momentum and success, they're generally have an understanding of where they're going, and they have positive feedback loop or transparent feedback loop, they churn less. And so the people platform was more about like, how do you start thinking about investing in your own people, similar to what the credo of Johnson & Johnson in the past. Yeah. And don't forget that just because old companies had created this a long time ago, old companies are bad, it means that they had a thesis and some of it worked.
Yeah.
And so what are the things that we can use today in the way in which Amazon has grown, past companies like GM and Johnson & Johnson have grown for, remember, 50, 100 years in some cases, if you go back far enough, where our technology companies in some cases are not even more than 5 years old. Yeah. And like if you look at Microsoft, it's like 35 to 40 years old now. So you don't really have a lot of data of like, this is the best way to build companies. Right. So it's more about like, what are the best things that you can take from each parts of these companies over the last 100 years that you can use.
Yeah. Units of time as new currency. What were you trying to introduce there?
We prescribe to a philosophy of knowledge accumulation, and through knowledge accumulation, you can make better decisions. So you can kind of see this recurring theme of decision making, whether it's right or wrong, is just the process of acquiring knowledge. And so units of time for us is more about how do you compound knowledge, in some sense. And, over time, it's obviously evolved, and that was kind of our first iterations of thinking through it. But, like in some cases, life is very short. So you're trying to figure out how to optimize for what you need to get. But in some cases, it's pretty long. And so you kind of have to try to figure out the balance between the two of what you're focused on. And I think a company horizon, units of time really matters, right? There are moments when you just need to be very tactical, get things done as quickly as possible, and make sure you have the best data available to make the best decision. But then you also need to understand that it's going to take time to compound. And what does that look like? Right. And so a lot of this was just, framing the, again, goal of what it means to, create a North Star, what it means to have an atomic unit for your company. How do you orient yourself? A lot of these things that we write about quantitatively or qualitatively are really focused on, to be honest, creating that N of one outcome. Yeah. And so that's how, I would think about units of time is it's like a subset of how to get there.
Yeah. What's a common mistake people make when they're choosing their North Star? What's a misconception people have about what needs to be in their North Star?
They read a blog post and think they need to do the same thing, right? Yeah. If you look at any company that has been successful hasn't been because they've copied someone else's format. They've done really well because they just do what they do better. Yep. Right? They take other philosophies of what had worked at other companies and figure out how that could be injected into their company for what they do, rather than try to copy some other frameworks. And it's kind of like the Roman philosophy, right? Like the Romans didn't have like this innate religion at the start. They added different religions to continue to conquer more lands. Yeah. So it's kind of similar here in that as a company, you have your value sets that you care about, your principles that you don't want to change. But there are other tactics that you might want to change over time because you are, a company is an entity. It's like a malleable, entity at the end of the day. And so you want to make that happen because you have different cultural sets as you scale, different people that are coming on board, different ways in which you think about building product. It's not just like one hierarchical way. And even the great companies like Apple don't do it the same way across their departments of product development. It has its own culture, but they have principles and guidelines that they follow.
Right. What do you do when there are tensions between qualitative and quantitative analysis? When, what you think about something doesn't match with the data, or what your gut says doesn't match with the data? How do you sort of reconcile those or recommend people do?
Yeah, the beauty of having data and having it as a part of the equation and recognizing it's not going to be everything for you is recognizing that it's not going to be everything for you. At different stages of a company or different stages of anything that you do, there's only a certain amount of data that you can use to make decisions, right? Bezos talks about what is the least amount of data that I need to make a decision. That's essentially what you want across the board. What is the least amount of data that you need to have in order to make a good decision? We don't think about it too differently, right? So, when people say, what kind of data do you gather on the team? Well, the data that I have is what they've built over the last 2 years. Let's measure it. And let's give the team the benefit of the doubt to see what do they need to add? What are the strengths and weaknesses of the team that we need to have to interpret the data and help them move forward? So there's no right or wrong answer, to be clear, right? There are some cases where you have more data in the company. It's more explicit. You can understand where they're going. You can make better forecasts. The goal here, and why we take this approach and, why you guys have been asking about this for a while is that, the best data in the world is the data that sits in the company. Yeah. And the best way to assess it is by understanding how to take a look at the data that exists there. And by continually doing it, you can build better and better heuristics of each company. It's not about taking outside data and having a perspective, because that's pretty commoditized and it's lagging indicators. It's more, if you're an early stage company at a certain life cycle, what's the data that matters? And so we have different frameworks for each stage.
This has been Arjun Sethi. You follow Arjun Sethi on Twitter. Tribe Cap is the firm. Work with them. I'm certainly excited to work with them. Arjun, this has been a fantastic episode. Thank you for coming on the podcast.
Thanks for having me.
If you're an early stage entrepreneur, we'd love to hear from you. Please hit us up at villageglobal.vc/network catalyst.